All right, let's dive into some equity options today.
Sounds good.
We've got a couple of white papers here from REX
Oh,
Advisors,
yeah.
all about
Okay.
their equity premium income strategy,
Interesting.
EPI for short. And,
Yeah.
I got to say, at first I thought, oh, this is going to be a little dry, but
Oh.
this is actually pretty interesting stuff.
Oh, good.
So these papers, they use kind of different data points, different examples,
Yeah.
but ultimately they kind of arrive at a similar conclusion, which is
Okay.
you might be leaving some serious cash on the table
Interesting.
with your current covered call approach.
Right. So what are they saying?
Basically, REX Advisors is saying,
Yeah.
hey, instead of just writing calls on the whole index,
Right.
what if we zoom in,
Uh-huh.
get a little more granular,
Okay.
and look at the individual stocks
Yeah.
within that portfolio?
Got it.
So that's the big idea.
That's the big idea, and that's what we're going to be
Yeah.
talking about today. Okay. Sounds good. So what's our
So let's break it down.
mission here?
Yeah.
Laura.
What are we trying to figure out?
Today in this deep dive?
Yeah, so basically what we're trying to do is really understand
Yeah.
how REX Advisors believes they can get more yield
Okay.
out of a portfolio by targeting those individual stock options.
All right. I'm in.
All right,
Lay it on me.
let's do it.
What are we going to learn?
So, get ready for some implied volatility
Ooh.
and prepare to be surprised
Okay.
by how much the yield can change
All right.
from individual stocks versus the whole portfolio.
Okay.
Oh, and also, we'll be looking at why focusing on individual stocks might actually give you more upside
Or upside.
potential.
All right. I like where this is going.
Yeah, this is exciting stuff.
But, options can,
It can be a little complex.
make my head spin a little bit.
Yeah.
Luckily, we've got you here to
Well, I'll try to break it down.
guide us through all that.
Absolutely.
So,
So let's set the stage here.
okay.
Covered call strategies.
Yeah.
This isn't exactly a new concept.
No, not at all.
Right.
These strategies have been around for decades.
Yeah.
In fact, the CBOE S&P 500 Buy Right Index, which basically popularized this whole thing,
Right.
was introduced back in 2002.
Wow, 2002.
Yeah.
That's a long time ago.
That's a while.
And I'm guessing the current climate of low interest rates and the ever-expanding options market
Absolutely.
has made these strategies even more popular.
Definitely, yeah. People are looking for yield wherever they can find it.
Absolutely, yeah.
But here's where REX Advisors is really kind of changing things up.
Okay.
They're not just saying, let's just write a single call option on the whole index,
Okay.
like the traditional buy right strategy.
Okay.
They're taking a more focused approach.
Okay.
They're saying, let's look at the individual stocks.
Okay, so why? Why not keep it simple?
Yeah. Why complicate things?
Right, and just stick with the index as a whole.
So REX believes that their EPI strategy, focusing on individual stocks, can potentially lead to higher yields.
Okay.
And it allows for a more tailored approach.
All right, I can see the appeal of a tailored approach, but I
Yeah.
think to really appreciate this strategy, we need to
You gotta understand.
get a handle on this idea of
Implied volatility.
implied volatility.
Yeah.
Four.
Yeah, that's the key.
So break that down for me.
Okay, so think of implied volatility
Okay.
as the market's way of saying, this is how much we think this stock is going to move around in the future.
Okay.
You can almost compare it to the buzz around a stock.
Okay.
The more buzz there is,
Mm-hmm.
the more people expect it to move, up or down.
Okay.
And that's when those options premiums start to get really interesting.
Okay. I like that analogy.
Yeah.
So basically, higher implied volatility
Yeah,
usually means you can collect a bigger premium
exactly.
when you write a covered call.
You got it.
And bigger premium equals higher potential yield.
Higher potential yield for you as the option writer.
For me. Okay.
Okay.
I like it.
And here's where it gets even more interesting.
All right.
The relationship between implied volatility and yield
Okay.
isn't a straight line.
Okay. Meaning.
So, meaning that small increases in implied volatility
Okay.
can lead to pretty big jumps in your potential yield.
Interesting.
For example, REX was saying in one of the papers,
Yeah.
every time implied volatility increases by 10 points, you can expect roughly a 1% increase in your monthly yield.
Wow. So those incremental changes can really add up.
Yeah, they can really make a difference.
So tell me, how much variation in implied volatility do we typically see,
Okay, so
even within like a specific sector?
REX uses a really interesting example, the Selective FANG Innovation Index.
Oh, yeah, the FANG index.
Yeah.
I love those guys.
Those are the innovators
The innovators.
pushing the boundary.
Right. All the big tech companies.
Yeah, you got Tesla, Qualcomm, NVIDIA,
Yeah.
Netflix,
Right.
all those big names.
So what kind of implied volatility range are we seeing?
They found a huge spread
Okay.
in 2023.
Yeah.
Tesla, for example.
Yeah.
Their implied volatility was over 55%.
Wow.
Apple and Microsoft
Yeah.
were just above 25.
So that's a big difference.
That's huge, right?
Yeah.
So you can see what REX is getting at here.
Okay, so they're saying if you write a covered call on the whole index,
Yeah,
those high IV stocks like Tesla,
right.
they kind of get diluted.
You get watered down
Yeah, by the lower IV stocks.
by all the other ones.
It's like their potential is
Their potential is masked.
masked. Yeah.
Exactly.
Gotcha.
And their analysis shows just how much yield you might be missing out on.
Okay.
When they simulated writing calls on each individual stock in that index,
Uh-huh.
the estimated monthly yield was 2.4%.
Wait, hold on.
Yeah,
2.4
2.4
versus 1.2 for the
versus 1.2 for the whole portfolio.
a whole portfolio.
Yeah, so almost double.
So almost double the yield.
Yeah.
Just by
By focusing on the individuals.
wow, focusing on the individual.
And here's the real kicker.
Yeah.
The average IV of the individual stocks
Yeah.
was 37%. But the portfolio of IV was only 24.3.
It really makes you think.
It does.
If the traditional buy right approach is really doing it right.
Is it really the most efficient way
Yeah.
to capture that premium?
So how does REX advisors
How do they propose to
unlock
this
that
potential?
hidden potential?
Yeah, what's their secret sauce?
What's the secret sauce?
All right, to understand that,
Yeah.
we need to take a look at one of their white papers
Okay.
and dive into their Magnificent 7+3 portfolio example.
Magnificent 7+3. That sounds cool.
It's a good one.
Tell me more.
All right, so think of the biggest names in tech. Apple, Amazon, Google, Meta, Microsoft, NVIDIA, and Tesla.
Okay.
That's your Magnificent Seven,
The big dog.
the big dogs. And then they add AMD, Salesforce, and Netflix.
Okay, so we're talking about a real all-star
All-star lineup.
lineup here
Yeah, the top 10.
of tech giants.
Yeah.
What did they do with this portfolio?
So they simulated their EPI strategy over a 3-year period,
Okay.
writing out of the money, or OTM.
Okay, quick refresher.
Yeah.
Out of the money.
Out of the money just means that the strike price, the price you agree to sell the stock for,
Right.
is higher than the stock's current market price.
Got it.
So if the stock price goes up but doesn't hit that strike price before the option expires,
Yeah.
you get to keep the premium and you keep your shares.
Got it.
So in this case, REX
Yeah.
gets to keep all that.
Okay.
And what they found was really interesting.
Okay.
The median strike price
Uh-huh.
over those 3 years was 107.36.
Okay, break that down for me.
Okay, so that means on average, the stock price would have to rise over 7%
Okay.
above its initial price
Okay.
before someone would even think about exercising that option.
Okay, so they're collecting premium,
Yeah.
but they're giving themselves
They're giving themselves a cushion.
a cushion for the stock to grow.
Exactly.
Okay, I like it.
So how does that compare to
Yeah, how does that compare to just doing the traditional
S&P 500?
buy right on the S&P 500
Good question.
or the NASDAQ or something?
So they ran the same simulation for the S&P 500 and the NASDAQ 100.
Okay.
And what they found was that
What'd they find?
the median strike prices were much lower.
How much lower?
For the S&P 500, it was 101.62.
Okay.
And for the NASDAQ 100, 102.54.
So that's a noticeable difference.
Yeah.
So REX's strategy,
It seems to be.
where they're writing calls on individual stocks
Yeah.
instead of the whole index,
Yeah.
is consistently giving them higher strike prices,
Higher strike prices, more potential upside.
which means they get to keep more of the profit
Yeah,
if the stock goes up while still collecting that premium income.
exactly. That premium is key.
Okay.
And it's not just a fluke. This pattern held up even when you look at the lower quartile of strike prices.
So it's consistent.
It's consistent across the board.
Interesting.
Yeah,
Okay.
It's pretty compelling evidence.
Okay, but let's play devil's advocate for a second.
Okay, I like it.
Why bother
Yeah.
with all this extra work?
Why not just keep it simple?
Right? Why not just do a buy right on the index
That's a good question.
and call it a day?
Seems easier, right?
Yeah.
But REX addresses this directly.
Okay.
They're not just throwing darts at a board here.
Okay.
This approach is data-driven,
Okay.
based on a ton of analysis and simulations.
And that analysis is consistently showing that
Yeah.
focusing on individual stock options.
Especially those with higher implied volatilities.
Especially those high IV
Yeah.
can lead to those higher
A higher
yields
yields, more upside.
and preserve more upside potential.
Yeah, it's a win-win.
Okay,
But
but
of course,
there's no such thing as a free lunch.
no free lunch in investing.
Right, there's always risk.
Risk is always part of the equation.
And REX is upfront about the fact
They're very transparent.
that this strategy might not be right
For everyone.
for everybody.
It's important to remember,
Yeah,
anytime you're dealing with options, you really need to understand your own risk tolerance
your risk tolerance.
and your investment goals.
Absolutely.
What are you trying to achieve?
So before we wrap up,
Yeah.
let's just kind of review
Let's recap.
what we've learned so far.
So we've seen how REX is using implied volatility to their advantage.
Right.
We've seen how focusing on individual stocks rather than the whole index can potentially boost your yield.
And we've looked at how that granular approach could actually give you more room for those stocks to grow
More upside potential.
while still collecting those premium.
That's sweet premium income.
Right. Okay.
But now for the curveball.
I love a good curveball.
Here it is.
Lay it on me.
If this strategy is so great
Yeah.
and can lead to such significant yield differences,
Yeah.
why isn't it more common?
That's a really good question.
It does seem like a no-brainer.
Based on the data
Okay.
they've presented.
So what are we missing here?
Yeah.
What potential downsides or complexities
Right.
might not be so obvious?
Well, for one thing, managing individual stock options
Yeah, that's a good point.
is definitely more involved
It's definitely more work.
than just dealing with
One index option.
one index option.
You got to keep track of so many different things.
Right. You've got multiple positions, different expiration dates.
You might have to adjust your strategy for each stock.
Yeah. It's a lot more hands-on.
For now.
Hands-on. It's not passive. It's not a set it and forget it.
No,
Yeah. And that alone could be a hurdle.
a hurdle for some investors.
Some investors.
For sure.
Right.
And then there's the risk factor.
Right. Because anytime you're writing covered calls,
You're limiting your upside,
you're limiting how much you can potentially make.
especially if the stock really takes off.
Right. If it goes through the roof
You might be forced to sell at that lower strike price.
and you miss out on all those gains.
Exactly.
And while REX's strategy is trying to kind of mitigate that
They are trying to reduce that risk,
by writing those out-of-the-money calls.
giving it more room to run.
Yeah, but it's still a risk.
It's still a risk to be aware of.
for sure.
Absolutely.
And I imagine the tax implications could also be a little trickier
That's a good point.
than just dealing with the...
Definitely something to talk to your tax advisor about
Yeah.
before you jump in.
So there are definitely some trade-offs to consider.
There are always trade-offs.
The potential for higher yields and more upside is appealing,
It is very appealing.
but it comes with,
More complexity, potentially more risk.
compared to that simpler index-based approach.
That's a great summary.
So it really comes down to...
An individual investor's needs and their risk tolerance.
Right, it's not one size fits all.
Exactly. Everyone's different.
Well, with that, I think
I think we've given our listener
we've given our listeners a lot to ponder today.
a lot to think about.
Huge shout out to REX advisors
Absolutely.
for these white papers.
Yeah, great stuff.
And of course to you
Oh, well, thank you.
for helping us navigate
Happy to help.
all this.
And you die.
And to you, dear listener,
Yes. Thank you for listening.
thank you for joining us.
We hope you found this helpful
We hope you learned something new
and maybe sparked some ideas.
about REX's equity premium income strategy.
It's a fascinating approach.
If it's piqued your interest,
Definitely.
we encourage you to go out,
Do your own research.
do your own research.
And don't forget about those downsides we talked about.
Knowledge is power, right?
Absolutely.
So until next time,
Happy investing, everyone.
keep those brains engaged and keep searching for those aha moments.
We'll see you on the next deep dive.
See, it's definitely a lot to think about.
Yeah, it's a lot to digest.
But I feel like we've
unpacked the core.
we've unpacked the core of REX's strategy here and how it really differs from that
That traditional index approach.
traditional index approach.
Yeah, it's a whole different way of thinking about it.
And we've talked about some pretty compelling reasons why it might not be as common,
Why it's not more widely adopted.
given its potential.
Yeah, it's definitely more hands-on. It requires a real understanding of how options work.
Yeah, it's not just something...
You can't just jump in blindly.
You can't just jump in blindly.
You got to do your homework.
But for the right investor, it seems like it.
It could be a really powerful tool.
Yeah, it could be really powerful.
If you know what you're doing.
And it's really not about
No.
market timing.
It's not about trying to predict the future.
It's really about...
It's about looking at the data,
Yeah.
understanding implied volatility.
Understanding that
informed decisions
calculated decision.
based on that information.
It's more about having
A nuanced approach.
a nuanced approach.
Yeah, it's not about chasing the hot stock.
Not about the hype
No, it's about understanding those market dynamics.
and how you can
Position yourself to benefit.
Yeah, how to position yourself.
Exactly.
So it really highlights
The importance of doing your research.
Yeah, do your research, folks.
Understand the risks.
Understand the risks.
And make sure this strategy, or any strategy,
Yeah,
aligns with your own personal goals
right.
and your risk tolerance.
Well said. Thanks.
I think that's the perfect note to end on.
Yeah, I think so too.
We've covered so much ground today.
We've gone from the very basics of covered calls
All the way
to the intricacies of implied volatility
Yeah, and those potential benefits
of REX's EPI approach.
of REX's approach.
It's been a really fascinating discussion.
It has.
And I hope our listeners
Yeah, we hope everyone listening out there feels ready to go.
to dive deeper
Dive a little deeper
into this on their own.
if you're interested.
Big thanks to REX advisors for those white papers.
Yeah, really interesting stuff. And to you for guiding us through it all.
And to you out there listening,
Thanks for joining us.
thank you for joining us on this deep dive.
We hope you learned something new.
We hope you got
A fresh perspective.
a fresh perspective.
Remember, the best investments are often the ones we understand the most.
That's a great point.
So keep learning, keep asking questions, and keep exploring the world of finance.
Yeah, there's always something new to discover out there.
Absolutely.
Until next time.
Happy investing, everyone.
Happy investing.